Welcome to Bunnex Investment Group. In this video, we are going to be talking about candlesticks. So after going through this video, you may find yourself that you were trading candlesticks the wrong way. But before we jump into the whole video, make sure to subscribe to this channel where we share a lot about trading efficiently and in the steps of the dealer or the market maker, and as well check out the notification bell icon so that you won't miss any of our videos as we upload. So in this video, we are going to talk about the candlesticks in the market maker context, right? Basically, candlesticks market context. Then we are going to talk about the anatomy of candlestick formation. How do they actually form? And the last but not least, the foundation of all candlestick patterns. You may actually find yourself cramming a lot of candlestick patterns, dojis, black cloud cover, and so forth. But we are going to talk about the most necessary two groups of candlestick patterns. So the first topic is candlesticks market context, right? So candlesticks are meaningless in the wrong market context, as we all know that the market flows in an upwards or a downwards movement. So for example, a hammer in the middle of a trend is relatively meaningless. If you see a hammer in this case, probably it won't be of any significant use. So candlestick patterns can only be defined at the close of the candle, and this is to avoid the behavior of candlesticks to provide their true identity in the last part of the candlesticks period. I'm sure you've actually seen that at one point you see a candlestick actually giving a very fast moving pace to the upside, which will be in green color, of course. Then in the last 2 minutes of that candlestick, it might be an M15 candlestick or an H1 candlestick. In the last minutes, you'd see that candle actually retracing back and actually ending like this, right? So in areas where there is intention to convince traders to take the position, the opposite side, market makers will leave the candlestick as a solid green or red candle until the last moments when it is pulled back to revealing itself as a spike candle. So this whole mention is actually to give you an idea that only validate candlesticks when they have closed, right? That is only point when you can see the true nature of a particular candlestick. Then from there, we move to the anatomy of candlestick formation, right? So this will give you an idea of how these candlesticks actually get formed on our charts. So the most important psychology behind candlestick formation is usually that the first color of a candlestick is not the real one, right? If you tune your time frames to the M15, M5, or M1, you may discover that, or you may notice that when a candlestick is actually forming, it usually starts with a different color to the color that is going to close with. So for instance, a candle may start as a green candle, right? Then later you'd see it as a red candle. So this is done as a way or as a micro closure of the small price gap created in the smallest price movements, right? This gives us another interesting thing. Whenever price is actually moving, right, it usually gives gaps that are seen on the M15, H1, or H4. So we all know that there is a rule whereby if the market gaps, we usually expect to see the market closing that gap. So in the micro movements of the market, which is basically seconds, in a 1 second time frame or 5 seconds time frame, usually there will be gaps that will be created between candlesticks. So these gaps are also needed to be closed, right? So that is why you would see the market actually starting as an opposite color to what it intends to do at its closing price, right? So this is the same basis of the market gapping. And when the market issues a gap in candlesticks flow, usually it will close that gap. So in counting levels, we deem the price gap as an impulsive move. When we see that the market gives us level 1, level 2, and it gaps here, right? We actually consider this as a price move, right? It's actually a price move that wasn't displayed usually by our brokers or by our liquid providers. So whenever we see a price gap, we know that the market is definitely going to close that, probably and then continue later. So the most important point here is when a candle is being formed, it usually starts with an opposite color or on an opposite characteristic to what it intends to do at its closure. So if you grasp this concept, you know, you see or find yourself having an easier time understanding how they form. Then we reach to the point where we talk about the most important candlesticks in our trading. So we have the spike candlesticks and the railroad tracks, right? So basically, spike candlesticks are the ones which comes with several or different names in the trading context. You'd see them being called the morning star, the evening star, the shooting star, and so forth. So these candlesticks are designed to get you excited or trade emotionally. They are very fast shooting candles that are meant to induce traders in the opposite direction. So these usually comes against the market maker bias, right? So in this case, we are saying we have level 1, level 2, then at level 3, we are expecting to see the market go. In this case, this is the market maker bias or market maker context. Would see a candle actually shooting up, right? In this case, right? So this move is actually meant to induce traders to trade in the opposite direction which they intend to move next. However, price is pulled back before the candle is closed, and those traders who entered on the excitement then find themselves trapped. I'm sure you've actually had you once entered a trade which was actually left out on the candlestick spike. So these are usually issued during news releases. So why is all this important in your trading? So it is wiser to note the market maker cycle first. That's the only thing that you need to know. It's actually a fundamental job to know where the market makers are moving or the market maker cycle, and wait to enter the opposite direction to the issued spike, right? So what do we mean? In this case, we can see that this was odd against dollar. In this case, we had level 1, right? In this level 1, we had this consolidation phase, right? In this consolidation phase, we can see a spike candle in the opposite direction to the market maker context. So in this case, it was wise for us to enter at its closure in the opposite direction to its spike. So it's usually you need to know the market maker context, right? And then try to enter in the opposite direction. As you can see here, we had several spike candles. In this case, this was a spike candle, and the market maker context was in this case. So the verdict or the conclusion on spike candles is know the market maker cycle. After knowing the market maker cycle, enter in the opposite direction to any spike that goes against the market maker cycle. That way, that is how those code sniper entries are created. Some people can actually enter whilst the spike candle is still moving in the opposite direction to where it's coming from. Like in this case, at one point, this candlestick was all green, and someone could have entered whilst it was still on the rise and then leave the price to go its way. Then another important candlestick group is railroad track. This is the mother of bullish engulfing patterns, cloud cover, and so forth. There are several that actually comes under the railroad track, and we have talked about a lot we have talked a lot about how to determine the high of day, HOD, or low of day on this channel. And this candlestick pattern is a reversal setup at the high of day. I'm sure if you've been following this channel for a long time, you've seen some of our videos where we talk on how to determine the high of day or low of day on the price chart. So the railroad track is a candlestick pattern that comes or that is anticipated to be seen at the high of days. This is a market maker M15 cycle 1, 2, 3. So at the high of day, that is when you'd see a railroad track. So basically a railroad track are two candlesticks of almost the same size side by side. One will be red, the other one will be green, or it may give you another one like this, right, to give you 4 candles or 2 candles. So after seeing 3 swipes to the low or high, a railroad track is a valid point of entry. So whenever it is issued after 3 swipes to the low or to the high side, and you see this pattern, it's a valid point of entry. So railroad tracks trick people into going in the direction of the first candle. So usually maybe this one will be a green and this one will be a red. So most likely people will actually go in the direction of the first candle. But later it is snatched away quickly on the next move. You'd see this one actually going in the opposite direction to this one. So it's all about knowing where to look for these candlestick reversal patterns. So we've talked about the spike candles and then the railroad track. So in this case, we can see that we had a move opening, right? This is an Asian session that coincided with the market maker cycle, right? An Asian session that coincided with the market maker cycle. You may check out that video on this channel where we talked about this. Then after that Asian session, we may see that this was the high of day that was issued. On that high of day, we had the green and red candle of almost the same size, and at closure of the red candle, that is when we actually entered the market to go down with the move. So the first thing is to know the market maker context. After knowing the market maker context, we now need to see a valid entry point. So all the candlesticks that we've defined, which are the spike candle category or the railroad track category, also works at the high of day or low of day. You may also see them at the second leg of an M or W pattern, and they'll be all valid. On that note, we come to the end of our video. Thank you for watching. Like and subscribe.